Hello and welcome to this episode of Akrinos Access Live. I'm Eric Matei, joined by Adam Cmejla, CFP. Adam is the president and founder of Integrated Planning and Wealth Management. And today we're going to have, we've got an incredible conversation lined up all about how to prepare your practice financials to sell. And this is something that whether you are an established practice owner looking to make that transition, looking to sell your practice, or if you're one of those thousands upon thousands of doctors out there that's looking to get into ownership and perhaps purchase a practice, again, this episode is for you. Adam is the foremost leading expert on helping prepare practices and doctors for this momentous occasion, and couldn't be more excited to have him on the program today. Adam, welcome to Akrinos Access Live.
Eric, thank you so much for having me, my friend. I'm looking forward to the conversation. You're too kind with that introduction, though. I'll take it. I appreciate it.
Well, anyhow, hey, unless something changes today, I think, you have a lot of really great things to bring to the table. And this is a conversation that we come to exploring quite a bit. And I know we've collaborated in supporting some doctors with this. So let's go ahead and just take it from the top. Adam. And let's just talk about the role of solid financials for practice owners. And maybe even prior to that, when we talk about financials, let's even just start there and help people understand exactly what we're referring to.
Well, I love math. Shocker, right? For a CFP to say that they love math. I love math and the numbers because it takes the emotion out of the equation and it democratizes the advice. When you talk with a practice owner that has owned a practice for 5, 10, 15, 20, 30 plus years, there's an incredible amount of emotion and bias attached from the seller's perspective about what they think their practice is worth and what they think another willing buyer should pay for it. And when you democratize that and create some rules, boundaries, and guardrails around what the business is actually worth and apply generally accepted accounting principles, GAAP principles. And again, as we talk here today, I'm going to be dancing that fine line of where what we do as advisors and what a CPA would do in the context of this transaction, this transition, right? The important point here, sidebar, is to have your collective team to help you navigate this important transition. Again, whether you're the buyer or the seller in this equation, but from our perspective as the advisors on the personal and professional side of things, when we apply basic business metrics to an optometric practice, it levels the playing field so that at the end of the day, the buyer of a business can understand what they're buying and the seller understands essentially what they're selling, which is this, Eric. Any buyer or any seller owns or wants to buy a business because they want predictability of future cash flow. That's it, my friends. That's all that a business means. Everything comes down to cash flow. Cash flow is king. There are so many different cliches around this,
Sure.
But at its core, it doesn't matter. That's what you're buying, is the predictability of future cash flow, and the relationship of that predictability is going to influence what a willing buyer will pay for a business and what a willing seller should expect to receive from their business. So that's why it's so important to standardize the financials in your practice and make sure that they're cleaned up and dare I say legible, so that you both, all parties involved, can understand what it is that we're looking at here.
Yeah, that is so important to point out. And really the key takeaway being that we're removing the emotion from it, right? And Adam, as a matter of fact, as you were kind of sharing that, actually different projects came to my mind with clients that we have helped and see successful, smooth transitions. And then unfortunately, situations where it did not go smoothly and having to look at alternative means of making the deal go through, or unfortunately deals not going through. So I think it's important for our listeners to glean two things. Number one, obviously you got a ton of blood, sweat, and tears. As a seller, you got a ton of blood, sweat, and tears and de facto emotion around it, right? So the financials can remove that and objectify it, right? But number two, then, from the standpoint of a buyer And I guess in this case, also a lending institution, considering that most of these folks buying practices are going to go take out a loan, right? But it assures that buyer and that lender that, hey, this, to your point, cash is king. This thing has predictable cash flow potential. Let's go for it.
Yeah, and it's from a lending perspective, right? Buyers should understand that an underwriter, a lender is going to. There's two parties involved. Yes, you have to qualify primarily, or you have to qualify as the borrower because there's going to be a certain amount that potentially is going to be guaranteed by you as the buyer. But at the end of the day, the bank has to underwrite the business. So the
Absolutely.
business, at the end of the day, what the financials of the business say is what's going to ultimately dictate how much the buyer is able to qualify for when it comes to financing. So from a seller, and this kind of dovetails into one of my greatest, not greatest, but one of my most passionate and like
you can say greatest. Adam, you can say greatest.
Okay, well,
this is access. This is Akrinos. You can say greatest.
It's one of the most common things that I hear. I just heard it 30 minutes, Eric, before we got on this call. I was on a call with an OD, and they're like, well, our practice has a lot of potential. And my snarky response to that, because and what they're going for there is, well, there's a lot of potential in my practice, so therefore it's worth X. And my snarky, somewhat passive response to that is, let's just say Dr. Smith, have you ever watched the show Flip or Flop or Fixer Upper? If they have a house that they think is worth $350,000 in the beginning of the show, do they buy it for $350,000? No, they buy it for the fair market value of what the house is right now. And then as the new owners, they will invest the blood, sweat, tears, equity, financial cash infusion into the house to fix it up, bring it up to its actual potential, and then make the decision of, do I hold or do I sell, et cetera, et cetera. So for sellers out there, if you feel like your practice has a lot of potential, that's awesome. But understand that a well-educated buyer is not going to give you and purchase a practice on potential. They will purchase the practice based off of the consistency of cash flow over the past 2 to 3 years, period, full stop. It's up to the buyer then to capture that latent potential that's observed in the practice, because the rhetorical response, or the not rhetorical, excuse me, another snarky response is like, well, if it's potentially there, why haven't you captured it?
Yeah, right. Absolutely.
I'm probably not making many friends here, but I'm just being truthful, right?
but also, hey, look, it's important. I don't think it's, look, this isn't to, what this is really all about, at the end of the day is what to do in the practice now, how to prepare the financials now, so you can show that off, right? Okay, and I'll say this from a standpoint of, look, we get a ton of folks that come to us that are ready to get into practice ownership, and the fact is, if someone's an entrepreneurial OD and they want to own a practice, there's two avenues: they're cold starting or they're purchasing. And I think it's also, so it's important also for sellers to realize, to understand, like, you're also competing for that entrepreneurial OD that wants to move into that market, or that entrepreneurial OD that's already in your market that you heard through the grapevine. They're ready to, they were maybe a leaseholder over here and they're ready to get into ownership, or they were an associate over there in a corporate setting, they're ready to get into ownership. You have to realize that they know they're going to be going to the bank and borrowing 400, 500, 600,000, and if purchasing a practice, perhaps above that, if the practice warrants it, right? But I think it's another really key piece to throw out here is, you got a bunch of entrepreneurial modern ODs that are ready to get in the game. So what can you do to have your practice be an attractive alternative to cold starting or to purchasing the practice down the block? By the way, I did want to toss this out there. We've got Nate Vang. He's a banker out in LA with Bank of the West, and Nate and I have come to do some really great collabs. And he commented here, he loves, Adam, what you were saying about potential, right?
Right.
And mind you, look, this is coming from a banker. These bankers, if they wanted these deals to go through, man, let's give them some good, solid, quality financials around the practice, so that they can get it through. So, all right. So, man, what a blazing start, Adam. Like, okay, so
out of the gates running. Out of the gates
running. Okay, so we understand first and foremost, the importance of these solid financials. So now, why don't you walk us through, particularly when we're talking about the P&L, the balance sheet, cash flows. Drop some of this knowledge to all those doctors tuning in that are at the stage where they are looking to prepare their practice to sell. Man, where to start? Because it can be a lot.
Well, so I hate to sound like a broken record here, but again, it all comes down to cash flow. And this is the challenge that some sellers will find themselves in, is it goes against the grain of what they have largely spent a lot of their career doing, which is I want to be careful here because I know this is being live streamed and recorded. How do I strategically plan the expenses in my practice so that I pay the least amount of taxes as I'm legally obligated to pay? Dancing that fine line of tax avoidance and, dare I say, tax evasion. We are always on the former. Being on the latter earns you an orange jumpsuit. Right? We do not want any ODs trading in their lab coat for an orange jumpsuit. So please stay on the tax avoidance side. Do not become a player in the tax evasion sandbox. So one of the ways in which practice owners will do that, there's a myriad of ways in which they'll do that. They will hide a bunch of personal vacations and a bunch of personal expenses. One of the other relationships that we were just talking about admitted that they probably run a few more Costco expenses through the practice than they probably should, because those are, again, office expenses. And so there's a lot of these things that will get hidden in the practice financials, which when you're practicing and when you're trying to reduce your taxable income and save as much on taxes as possible, serves you very well in that lane. But now, one of my 3 favorite questions that I ask in almost everything in life, this being included, 3 successive questions. Number 1, what am I solving for? Number 2, in service of what? And number 3, at the cost of what? And so if the goal shifts, so too does the action that you have to take. If the goal now is, well, okay, I'm teeing up this practice in the next 24 to 36 months, I want to sell this practice. If I'm kind of live, stream of consciousness, I listened to this guy, Adam, talk on a live stream one time, and he said that cash flow is king, and that what I'm buying is the predictability of future cash flow. Ergo, it would behoove me as the practice owner to show a potential buyer, look at all this cash flow that's at the bottom of my profit loss statement. Look at all, and yeah, there might not be a lot of soft dollar expenses like depreciation and amortization. So the net operating income of my business is actually really healthy. Does that mean that I might pay more in taxes today? Yes. Sidebar, there's financial planning strategies, whether it be profit sharing contributions, cash balance contributions, a defined pension plan, kids on payroll. There's all kinds of different personal planning strategies that you can insert into the practice that are very easily explainable during the conversation of buying and selling. But from a pure operating expense of, when we look at the business and we look at a practice, OPEX, the operating expenses of the business, how much does it cost to operate this business? I'm sorry, I can't include, you got to get your Costco expenses. You've got to get your vacations, your family vacations as a CE event. Get those out of the practice, because yes, it's going to make your net operating income higher, which is okay, because what you told me, what you're solving for is bigger, higher enterprise value of the practice. In service of what? Well, I want to extract max enterprise value out of my practice when I sell it to a willing, able, and informed buyer. At the cost of what? Okay, does it mean I might have to pay a little bit more in taxes today? Yes, maybe that's the case. Maybe not if we work some of the financial planning angles there as well. But that's the mindset that has to shift first and foremost, is to clean up the financials and give a true representation of, here's what comes in top line revenue, right? Anybody that's heard me speak or have listened to 2020 Money, yes, I got a shameless plug in there, Eric.
Absolutely. You are welcome. There is no shame. There's no shame. 2020 Money. And by the way, for those of you that have never connected with Adam, definitely go subscribe to 2020 Money. Amazing stuff through and through. So continue.
Yeah. Which sidebar, you and I just had a conversation that just came out on 2020 Money that we
That's right.
recorded live at Vision East at Expo East about this buy versus build concept.
That's right.
So and those of you that have heard me talk on 2020 Money or the presentations, conversations that I've had, a business is like a game of Plinko. We drop $1 into the top line. That's top line revenue. Cost of goods, direct expense equals our gross profit, right? So we want to make sure that we control that expense as best as possible. And then you have your OpEx, your operating expenses of the practice. Every line item on that profit loss is shaving cents off that dollar, so that what drops to the bottom is what I, as a buyer in the transactions world, there's something called discretionary seller earnings, DSC. How much discretionary seller's earnings am I going to be able to get out of this business when I sell it? If you're hiding all of your personal expenses in there, ladies and gentlemen, it's going to look fictitiously low, and that's going to influence the offer that you're going to get. So I don't mean to keep beating the same concept, but getting that right is going to allow the other two important financial statements, your statement of cash flow and your balance sheet, to become a little bit more right-sized as well, so that a buyer looks at this and says, I can make an educated and informed decision about what the value of this practice is.
Absolutely. Absolutely. And the two things that I want to toss out there. It is so true. Adam, we have had, I mean, I think I've shared this with you offline, right?
Right.
It's heartbreaking to see these deals come through where you've got these practices that are, gross and near a mill, and yet a bank won't touch them. The valuation is garbage, and the bank won't touch them because it's in disarray. It does no one any good. So it was one of the things. Then the second thing is to consider, to kind of build on that, right? I mean, if you're catching a 4x multiplier on that EBITDA, then each of those dollars is multiplied by 4.
Absolutely.
Right? So that really puts in perspective the tax savings today, but then the detrimental impact in the future, given that we're running those expenses through the business. We're not able to show, and that term that you use, seller's discretionary cash flow, seller's discretionary earnings.
Yep.
Really, really important for everyone to understand that that's what is going to put that buyer in the hot seat. And to that end as well, understanding that, well, the buyer is finding their way into entrepreneurship, whether they're going to purchase your practice or cold start or purchase something else. Most of these folks are looking, they want to come up on something good.
Well, I think it's so important, and I'm so glad that you pointed that out, that the $1 that you drop to the bottom line of your EBITDA, of your net operating income. And again, I hit on this indirectly about your amortization and depreciation are not necessarily right. That's why we talk about EBITDA, earnings before interest, taxes, depreciation, and amortization. Those aren't hard dollar business expenses. But if you increase that EBITDA and you can now demonstrate to a buyer, hey, look at all this healthy cash flow over here, and they, instead of giving you a 3, give you a 4, 4.2, 4.3 multiplier, that $1 extra that you drop to the bottom line is now 4 times what you otherwise would have gotten. So I'm really glad that you pointed that out. That's a very astute, or very, very direct and concrete return on investment, essentially, that a seller should think about.
Absolutely, and it goes without saying, I think for many sellers, it's just kind of the way they've always done things, right? Oh, we've always done that family vacation around market research or a CE, and what have you, or the Costco bill, or whatever the case may be. But I think it really is important to realize when you are looking to transition. And by the way, this topic is, preparing practice financials to sell, but the same exact merits, all the same exact stuff is preparing financials to bring on a partner, right? Because we know how many practices out there have the associate, and now it's time to make that associate the partner. All these same principles apply, right? Anyone that's going to be buying into that practice, whether buying outright or buying in as a partner, going to want to be sure that all the stuff is lined up. So moving along. where to start? And by the way, I don't mean to kind of shift. I'm glancing at the time. We usually keep these live casts to about the 30-minute mark, and we're motoring through. So maybe now let's start to transition into, where to start. How to identify where things are broken. How to find the right solutions out there to get you on the path.
Well, I think at the end of the day, it comes, not to be so cavalier about it, or maybe the Captain Obvious statement is a better way to say it, but garbage in, garbage out. I mean, you've got to make sure, you have to make sure that your books are in order. You have to make sure that you're reconciling accordingly. Just had a conversation the other day as well with an OD that was talking about, oh, well, we had 1.2 million in 1.2 million in gross build. I'm like, can't spend gross build. What was gross collected? Oh, it was 650. Now there's a different conversation in itself, why you did 1.2 versus 650. Like, again, separate practice management conversation. But again, cash is king. So what hit the bank account, and are your financials accurate? Again, long time, those that have heard me talk about this in multiple different forums, know your lane, pun intended, as an OD. This is a who, not how conversation. If you're still reconciling your own books and you're not confident in that, or you are reconciling your own books, and you're like, regardless, that is something that I'm a big proponent should be delegated. I'm a CFP and I could reconcile my own books almost blindfolded. And I don't ever want to reconcile my own books again, because it's not the best and highest use of my time in the business. So again, that's a business coaching conversation. Hire experts to make sure that the financials are accurate, that you're reconciling what actually hit the bank account, what actually was charged in a credit card, what actually went out in checks, etc. That is matching up on the financial statements. And that serves multiple different benefits, not only for selling the business, but you'll have a happy CPA and advisor come tax time as a little icing on the cake there. So that's first and foremost, is to make sure that you have those numbers on the balance sheet side of things. This is one, and Eric, maybe you can speak to this as well. The area that can sometimes be a little bit of a hiccup is the inventory side of things. Just have somewhat of an understanding of what you hold in inventory. Also, do what you can to close up and not have a significant amount of accounts receivable outstanding. From a buyer's perspective, if we see 60 and 90-day ARs really starting to grow, it's like, ooh, what's going on here? What are the billing practices in place? What's your collections process? So that can also be some weights around the ankles, if you will, about what a buyer is going to look at and what might raise some red flags. And then certainly on the balance sheet side of thing as well, deleveraging the practice, right? Nobody's going to want to buy a practice that's been completely deleveraged to the hilt, because at the end of the day, the same thing that we hear in personal finance, assets minus liabilities equals net worth. The business version of that is assets minus liabilities equals shareholder equity, right? And so if you've loaded up the practice in a significant amount of debt, a buyer is not going to want to buy that business with all that debt attached to it. So you as the seller are eventually going to have to pay off that debt. So worst case scenario that happens is you've got a practice that's loaded up with a bunch of debt. They get this windfall, and then they have to pay off the debt from the practice and might walk away with nothing, very little, right? So do what you can also to deleverage the practice in a reasonable way, right? There's and this again goes when we have conversations with ODs. It's like, I'd like to sell my practice this year. I'm like, okay.
I'm really glad you bring that up. I'm really glad you bring that up, Adam, because that's where I was going with this. Like, seeing it is a lot to unpack. How far out?
Yeah, we're not going to solve it in 30 minutes here, right?
Sure. But I think it really is important, because look, I mean, we get folks contacting us as well. That's kind of like things that, all right, there's some time element to things that we need to be cognizant of. But so as it pertains to this, yeah, definitely not something you want to do year of. As a matter of fact, I think to pass the previous episode that you joined us on Access, and we were talking about, as a matter of fact, it's that 3-parter, right? As far as setting up some tax strategies and stuff like that, but help viewers understand kind of when they should start looking to do this stuff.
3 years. 3 years is the best. It is 3 years plus or minus. I mean, if you want to do 2 years, think of it this way: can you decide this year that you want to sell your practice by year end? Absolutely. And will you get a decent value for that? Sure. Okay. Let's just, all things being equal, maybe. Okay. But what you don't have is the benefit of time, and you lose with the shorter that time period of when you decide to sell versus when you actually close on the transaction. The shorter that time period, the fewer planning arrows in the quiver that you have to improve the valuation of the practice, to improve the enterprise value of the practice, should you need to do that. And I dare I say should. Like, I don't think anybody would want to leave equity on the table, leave value on the table, if for no other reason than they didn't plan. So 3 years gives you that timeline to get clarity about what the practice is right now. If something's broken, if there needs to be improvement, great. We've got a runway of 3 years to be able to fix that, so that 3 years from now, when we have a buyer, they can look back over 2023, 2024, 2025's financials and say, oh, yeah, here's the proof of concept. We're not buying on potential. We've got the actual financials to support that, as well as the other personal planning considerations from a tax, et cetera. I'm just talking about the practice financials here.
Absolutely. Yeah, absolutely. And you know what, on that note also, when you think of some of those other moving parts above the line, right, that could take some time to line up, but can have significant impact. A biggie is going to be cost of goods. And particularly now, as we have seen the role of managed care, these vision plans, changes to the supply chain, we're seeing more and more practices, man, those margins are being chipped away, right? There's a lot of folks that cost of goods is being driven up. However, at the same time, there are now more than ever some really cool solutions out there that folks can pivot to, but it takes time, right? Like, you can't go from, the 35% cost of goods to 25% cost of goods overnight, or even a 6-month period. So this is where it's important. This is where it's important to understand that from the financials, that then, and the importance of this 3-year time span that Adam tossed out there, right? It's realizing that there are likely going to be practice management adjustments that are going to need to be made in the practice to support, hey, what is this financial plan that we've put in place? And then something else that I wanted to touch on, and perhaps you can elaborate on just a little bit here, is some of the tax strategy options, right? Considering that it sounds to me like one of the biggest opportunities here is really about removing personal expenses from operating expense. I mean, that's arguably going to be one of the biggest movers. Okay, but maybe just briefly comment. And I know we're closing out here, but maybe just comment on some of the tax strategies that folks will have available to them as they remove those personal expenses from the business.
Yeah, the two most common ones that are going to be applicable to practice owners, and this does coincide from an age standpoint, where these strategies are going to be most advantageous to sellers that are going to be selling in their 50s, mid 60s, heck, some even might in their 70s. If you have a qualified retirement plan in your practice, like a 401k, a 401k by definition has a profit sharing component to it. You just might never have made a contribution to it. And so looking at making discretionary profit sharing contributions, what is even potentially more advantageous is looking at cash balance plans or a full-fledged defined benefit plan inside the practice. Defined benefit plans can be used in the year of the practice sale to essentially fund a pension plan inside the business that has just been sold. Again, lots of details, lots of moving parts on that. But if you just write down those 3 things: profit sharing contributions, cash balance plan, defined benefit plan, those 3, and talk to your advisors to see if it makes sense. Those are the big levers, low hanging fruit strategies to consider in those couple of years.
Wow. Amazing. Hey, for those of you just joining us, well, I hate to say it, but you're going to have to catch the replay because we've been hanging out here. Adam Cmejla has joined us here, Akrinos Access Live. We're talking about preparing practice financials for sale. Adam, before you go, please do share with folks what y'all are into, the type of work y'all are doing at Integrated Planning and Wealth Management, and how folks can get in touch with you.
Thank you, Eric. Again, I appreciate you having me on your platform here today and sharing this conversation. Integrated Planning and Wealth Management, we are an advisory firm, consulting firm that works with ODs nationwide. We have our team members are all over the country as well. We work with ODs, and I believe we're in 34 states right now. Our goal is to serve as your personal and professional CFO, helping you manage the 3 tenets of personal and professional planning, proactively managing cash flow, reducing taxes, and investing prudently. All of those are done through the filter of having the practice serve you on purpose so that you can live your best life on purpose. The producer and host of the popular, I think I can say that, we just crossed 250,000 total downloads in the podcast. So I'm really excited about
man.
that.
Congrats. That's awesome.
Thank you. 2020 money. So 20/20 as if you're refracting down to 2020. 2020 money is the podcast, new episodes every single Monday morning. Again, all of that is on the website there. And then soon to be launching here within the next 30-ish days is the 2020 money membership, which is going to be what we're calling a co-pilot guided independence approach to helping ODs make the best financial decisions that they can, help them become brilliant at the basics. That'll be part of the podcast community as well. So all of that information is on the website, integratedpwm.com.
Mr. Adam Cmejla.
Just a few things going on.
Just a few things. Adam, thank you so much. Thank you really so much for this marvelous, wonderfully insightful conversation all around preparing practice financials to sell. Y'all heard it, folks. It's a remarkable time now to be in practice ownership, to get into practice ownership. If you're looking to get in touch with Adam to learn more about how you can prepare your practice to sell and other tax strategies, financial planning strategies, again, you can connect with him through integratedpwm.com. On behalf of our team here at Akrinos, you know where to go looking for the latest and greatest in modern practice management solutions, that being Akrinos.com. Follow us across the socials, subscribe to the YouTube channel, and wherever you are and whatever you're going for, we're just wishing you all the best. Keep going for it. Adam, thank you so much.
You're welcome. All the best and continued success to you and everybody else that joined us. Thank you so much for the time this afternoon, Eric.
Absolutely. Thank you.